In today's economy, corporations seem to have an endless supply of capital, thanks to cheap debt. This borrowing allows companies to expand rapidly, create jobs, and increase their profits. At least that's the theory. But if that's the case, why are so many workers still struggling with stagnant wages, job insecurity, and limited benefits? The truth is, while corporations benefit from borrowing, the benefits rarely trickle down to employees. Let's take a closer look at why this debt-fueled system often falls short for workers, and what a shift toward an ownership-based model could mean for their future. In a debt-driven system, companies can borrow money to fund expansions, acquisitions, and new projects. However, this borrowing is rarely used to improve conditions for workers. Instead, corporations often use loans to grow their businesses, focusing on increasing shareholder value and profit margins. These investments are designed to benefit executives, shareholders, and investors, not the people doing the work. For example, companies may fund stock buybacks or increase dividends for investors, rather than reinvesting in their workforce. As a result, workers often see little to no improvement in their wages or working conditions despite the company's expansion. Even though corporate profits have been on the rise, wages for the average worker have remained stagnant. The reason behind this is the system's focus on cost-cutting and maximizing profit margins, rather than increasing compensation. When companies borrow to fund their growth, they are often under pressure to meet short-term profit goals. This leads to decisions that prioritize immediate returns over long-term worker benefits. Instead of rewarding employees with wage increases, companies often invest borrowed money in expansion efforts that don't directly improve the financial security of workers. The result is a widening gap between rising corporate profits and stagnant wages for employees. Corporate expansion fueled by debt can also lead to job insecurity. While borrowing may create new jobs, these positions often come with little stability. To keep costs down, many companies rely on part-time, temporary, or contract workers, rather than offering full-time positions with benefits. These workers are often left without healthcare, retirement plans, or paid time off, leaving them vulnerable to layoffs. Additionally, the cyclical nature of debt-fueled expansion can create periods of rapid hiring, followed by mass layoffs, leaving workers unsure about their long-term job security. This unpredictability is one of the major drawbacks of a debt-driven system, leaving employees at the mercy of financial fluctuations. In addition to job insecurity, working conditions are often sacrificed in a system driven by the need to meet debt obligations. Companies facing pressure to generate short-term profits may invest in automation and technology to replace human labor, leading to job displacement. For the workers who remain, conditions may become more demanding as companies push them to do more with fewer resources. In some cases, companies also cut corners on safety measures to save money. Workers may find themselves in unsafe environments with minimal training and inadequate protective equipment. The focus on cost efficiency, rather than employee welfare, leaves workers with little support to manage the challenges of an increasingly demanding job market. There is a fundamental disconnect between corporate borrowing and tangible benefits for employees. In a debt-driven system, corporations are often more focused on generating quick returns to service their debt than on investing in their workforce. This emphasis on short-term profits leaves little room for long-term investments in employee well-being. Benefits like wage increases, health insurance, and workplace safety are often viewed as expenses to minimize, not as necessary investments that contribute to a healthy, productive workforce. This approach benefits shareholders and executives, but it leaves workers with little to show for the company's financial success. So, how could an ownership-based economy change the dynamic? In an ownership-based model, growth would be tied to actual profits and assets, not debt. Companies would need to generate sustainable income to fund their operations, which would encourage more responsible and long-term investments. Without the option to borrow excessively, corporations would have to focus on generating value through sound business practices, rather than relying on financial engineering or market speculation. This approach would prioritize profitability based on real assets, making it easier for companies to invest in their workforce and communities. An ownership-based system could also foster transparency and accountability. In this model, companies would need to operate with a greater degree of openness because their growth would depend on actual performance, not borrowed funds. Investors, workers, and other stakeholders would have a clearer picture of a company's financial health, which could encourage companies to adopt more responsible practices. With a focus on long-term stability, companies could create a culture of accountability, where the well-being of employees is prioritized alongside profits. One of the biggest benefits of an ownership-based model would be the potential for more equitable growth. Rather than focusing on short-term gains that benefit shareholders and executives, companies would need to invest in their employees as key assets. Workers would be seen as partners in the company's long-term success, with fair wages, benefits, and job security becoming central priorities. This would help address the wage gap between executives and workers, ensuring that all employees share in the success they contribute to. Environmental responsibility would also be a key component of an ownership-based economy. Since companies in this model would rely on real assets, they would have more incentives to protect the resources that underpin their value. For instance, a mining company would focus on sustainable practices that preserve the longevity of its resources, rather than rushing to extract as much as possible in the short term. This would result in more responsible resource management and less environmental degradation. Additionally, workers in an ownership-based model would have greater job security and better working conditions. Without the pressure to service debt, companies could focus on creating long-term, stable jobs for their employees. This would reduce reliance on temporary labor and part-time work, providing more workers with the opportunity for full-time employment and benefits. Companies would be encouraged to invest in their workforce, offering training, fair wages, and opportunities for advancement. In conclusion, while debt-fueled corporate growth has allowed companies to expand rapidly, it has not translated into real benefits for workers. Stagnant wages, job insecurity, and poor working conditions are the reality for many employees, despite rising corporate profits. A shift to an ownership-based model could change this dynamic by prioritizing long-term sustainability, worker investment, and environmental responsibility. In this model, companies would focus on creating real value through responsible business practices, benefiting not only shareholders, but also employees and the communities they serve. The future of corporate growth doesn't have to be based on debt. It can be rooted in ownership, accountability, and genuine profitability for everyone. Let's start the conversation on how we can make this vision a reality.